Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss with you guys American Funds Retirement and how you can obtain preservation, consistent account growth, and also a personal pension plan aspect if you have access to an American funds type of retirement account, or let's say you're currently invested in some sort of mutual funds through American funds, and that's set up through your 401k plan, your 403b plan, or just a typical IRA. Kind of show you what the mistakes that many individuals have made on why they can't properly retire, and then different ways on how you could roll this over into something that can give you that preservation, that consistent account value growth, and give you that safe consistency in retirement to essentially turn on lifetime income at a later date and time. So, with any sort of American Funds retirement account, you may be investing in a 401k currently. And essentially, what's been happening is you were working for a company, and let's say 10, 20, 30 years, and you keep placing more and more money into something known as a 401k account or an IRA account. So, your contributions year by year, you're placing a percentage, it could be 10%, could be 5%, whatever that is, of your salary, you're placing it into this 401k account. Now, what determines how large this bucket, this 401k account bucket will grow is the amount of money that you contribute and the percentage that it gains or losses or loses. So if let's say you place, $1 million into this account throughout the years, but yet your return was negative 50% in a given year, well then you're not going to have $1 million in that account anymore. It's just going to be 500,000. It's very simplistic. Or vice versa. You go and you have, you have a significant growth into your account. Let's say you have 500,000 in there and you have a gain of 50%. Well, now this will be $750,000 into that account value. So it's always going to be whatever you contribute plus whatever the gain is in there. And throughout time, all financial gurus, if you look up content, if you listen to the radio, they all say, okay, invest a portion of your monies, invest a portion of your salary into some sort of retirement account, and the market should always be increasing. It should always be increasing. Just basically stick with your guns. And American Funds is one of these companies that they have some really good, they have some really good mutual funds in there, and they've had some good past, very good past performance with some of their funds. But you have to understand something. There's a risk associated with any sorts of mutual funds. And it all goes down to a little factor known as reverse dollar cost averaging. And has been a integral part on why individuals cannot properly retire, because they try to leave their money in these 401k, in these IRA accounts, and try to still invest this money into conservative, moderate, risky type mutual funds. And it's a mixture of fees and downward market loss that can completely liquidate this account and make you outlive your money. So what do I mean by that? Well, with reverse dollar cost averaging, if you have your money in a 401k account through the American funds, and let's say your mutual fund, you have a mutual fund related fee that's there. Okay, let's say that this is 1%. It could be a little bit less, could be more. But let's say a safe haven is going to be 1% of a mutual fund related fee. An advisor, typically if you go to a financial advisor, they're going to charge you something known as a wrap fee. And what that means is it's just an advisor that says, okay, listen, you have a 401k, you have an IRA account. I'm going to choose your funds. I'm going to ask you a couple of questions. I'm going to, and based upon the information that you told me, I'm going to be able to place you into some sort of portfolio that should match up with exactly your goals based upon your risk tolerance. So if you answer something like you want to be very, very conservative, they're going to show you different ways on how to be a conservative, how to place your money into very conservative funds. Does not mean that is guaranteed to never go down. So I want you to really understand that. Now, for this financial advisor to give you his recommendations, they charge you something known as a wrap fee, and that's typically 1%. Could be a little bit higher than that. Depends upon which company you go with. So you already have the first fee, mutual fund related fee, which is only 1%. Then you have the second fee, which is the advisor fee, that's another 1%. So already before your year starts, and you're trying to at least have growth, remember this percentage that's going to gain, you have to already beat out those fees. Now, in 2008, and I always reference 2008 because it was such a real time. And I have so many, because I deal with so many people in my financial practice. We're an independent agency, so we represent all the top carriers. We represent hundreds of different carriers and products. At any point in time you need some help with your retirement plan, your retirement income planning, please give our 1-800 number a call, 1-800-566-1002. But essentially, we have individuals that call our office every single day, and the crazy part is every time that the market is crashing, that's when our phones are blowing off the hook, because we always focus on safe planning, about safe and consistency. So it's not until the markets actually start crashing where people start realizing, oh my gosh, Afaci Financial Group was correct this whole time. With 2008, every single time I ask this question, how bad did you get impacted in 2008? Some individuals were in cash accounts and they were very, very conservative, and those are the only ones that did not lose a penny. Majority of the times, somebody that was, invested in some sorts of mutual funds, stocks, bonds, whatever it was, they lost on average about 57% of their portfolio. Let's say in a given year, this individual, your money, you lost 10%, which is very realistic in a given year. Now understand something. As your bucket, regardless of how much you're placing in there, if you already have a negative 1% fee, a negative 1% advisor fee, and a 10% loss, that's already reduced 12% of your portfolio. When it comes time for retirement, let's say you're over the age of 59 and a half, or you're 65, 67, whatever that is, and you say, okay, I want to start pulling money from this bucket. Based upon the Internal Revenue Code, I could take money from this bucket after age 59 and a half and not get penalized from it, not get a 10% penalty from the IRS. Please understand, if you're watching this video, you cannot just pull money from your 401k account, your 403b account, or your IRA accounts before the age of 59 and a half. Some people make that mistake, and it is devastating, because you're going to get fully taxed on it, and you're also going to get a penalty from that. So let's say that you're over the age of 59 and a half, and you have this bucket of money, and now you want to take income from it. Well, how much income do you take? And this is something known as, whenever you look up with wealth accumulation specialists, they always tell you, take about 4% should be a safe haven. If you're leaving your money invested in the market, 4% should be a very realistic scenario. Well, there's ways on how to completely crush that 4% number and make sure that you never outlive your income. On top of it, that 4% is not guaranteed. So if you take out 4%, so let's say you have $1 million sitting into an account, and you took out 4%, which is what, $40,000. You would have taken out 4%, but you would have lost 16% in value. 16% of your entire portfolio, because of the mutual fund related fee, the advisor fee, the downward market loss, and you're pulling from that account. So if you just keep pulling from a bucket of money and you have no contractual guarantees on that, you're going to outlive your money. And this is what has happened time and time again, and why individuals cannot properly retire. So you have to understand the basic concepts on how to preserve these accounts, and the different ways on how to understand how you could potentially roll this over into something that will give you that safe consistency, with also a guaranteed contractual income at a later date in time, contractually guaranteed income from an insurance company at a later date in time. And you could do this in a couple of different ways. So let me just pull up a new screen real quick. So if you have your money invested in the 401k, and let's say you left this employer, in previous years you just recently left this employer, you now have access to roll over this money into one of these preservation type accounts. If you have an IRA, you could always transfer it over into the preservation type accounts, because this is an individual retirement account. You have more flexibility with that. And 403b, you have to leave employment. Or you could be over the age of 59 and a half. Typically, they have an in-service distribution that you could essentially take a portion of it and roll it over into one of those types of accounts. And I want to explain to you the generic concepts of it, because what happens is this beats out reverse dollar cost averaging every single time. And there are certain things known as indexing strategies, and what we do is we leverage different types of insurance companies, and we leverage something known as a hybrid annuity to allow you to have access to to eliminate any sorts of reverse dollar cost averaging effects to your portfolio. If you had a 401k, and let's say you severed employment, or you say, okay, listen, I want to retire and I want to roll this over, I want to make sure that there's some contractual guarantees on there. What happens is we eliminate the mutual fund related fees. And it goes off of something known as an indexing strategy, where let's say you go and you roll over $500,000 into one of those hybrid products. And there's tons. There's over 300 different types of contracts out there in your particular area. But what this does is it puts a little shell over your money. Anytime that the market goes up, you're going to receive credit gains into your account. Anytime that the market goes down, you're going to receive a gain of 0%. So you're going to always have that floor 0%, and there's a specific cap limit. Now, what distinguishes a good hybrid or index annuity from the next one, from a bad one, is how good is that cap rate? What exactly is that potential to gain in upward market years? But also understand that you're never going to lose anything in those downward market years. So right off the bat, we're eliminating that mutual fund related fee. The advisor fee. One of the things that make us different is we do not charge any advisor fees to our clients. We believe that education is the key. We believe that free content, free education to make sure that you understand specifically what you have and the different options out there. So we're going to explain things to you till we're blue in the face. Once again, I definitely stress call our 1-800 number at any time, 1-800-566-1002. We do not charge you any advisor fees. Downward market loss. Because this is known as the indexing strategies, the worst that you could gain in a given year is 0%. Let's say if you have this money tied to, and you're going to have different options with each type of contract out there. You might have like 4 or 5 different options, but let's say it's tied to an S&P 500, and that S&P 500 that year loses 57%. Well, you would gain 0% into that account. So it goes off of a fixed type aspect where rather than credit you a fixed percentage rate year by year, they're going to credit you based upon an upward market index. If the market index does not go up, then they're going to credit you, or let's say it goes down or doesn't gain anything, then they're going to credit you 0%. So you're receiving that preservation and that consistency that anytime the market goes up, you're going to have a gain. Anytime it goes down, you're going to have a flat line. Anytime it goes up, you're going to have a gain. Every time it goes down, you're going to have a flat line. And this allows for the power of compound interest to constantly be giving you gains and positive growth onto your account rather than the constant fees and that negative aspect of reverse dollar cost averaging to your portfolio. Then the very last thing is income. One of the things I explained to you is you have these different wealth accumulation specialists that they try to tell you, 4% is a safe haven. There's nothing guaranteed about that 4%, something known as the prudent man's rule, to pull out 4% of your 401k, of your mutual fund. There's nothing contractually guaranteed on that. With the reason why I like utilizing hybrid annuities and the indexing strategies is because it puts a secondary shell over it that says, okay, if you're, let's say, 55 years old and you place money into that and you want to retire at age 65, there's a specific dollar amount. There's a specific dollar amount on how much lifetime income the company will contractually guarantee you if you defer your income out for all that time. Let's say if you're deferring it out, and let's say originally 65 was your original number, but yet you want to retire at age 61, there's a certain number there. So obviously, if you try to execute that income rider, it goes off of something known as an income rider, not an annuitization, very important. You essentially execute that, and it will pay you lifetime income. If you take it at 61, it's going to be a smaller number than if you take it at age 63 or 64 or 67, whatever that is. So it's just like Social Security. If you take Social Security at age 62, it's going to give you a dollar amount. If you take it at 66, it's going to give you a larger dollar amount. So it's very, very important. I really wanted to discuss this because these are the mistakes. These are the traps. And American Funds is an excellent, excellent company. They do great with different types of retirement accounts. They have the 401ks, the 403bs, the IRAs. And, you want to be educated on and want to avoid those mistakes. If you're one of these individuals that you're looking to retire, you're looking to take this money for retirement income, and you do not want to go into it blindly, please give our 1-800 number a call. It's 1-800-566-1002. We're available 24 hours a day, 7 days a week, so you can just call on weekends and nights, whatever that is. And we also are accredited with the Better Business Bureau. We've never had a complaint. Reason being is because we want to make sure that you're comfortable. We want to make sure it's as personalized for you as possible. And later on, if you have certain goals and we could basically give you recommendations on that, we'll show you those recommendations. And if not, if you're doing everything perfect, we're going to let you know, listen, everything that you're doing is set up perfectly, but it's worth it to have that free that free education, to have that free advice, to make sure that you have an extra set of eyes on exactly what you're doing and you're not going into it blindly. One of the things that I really believe in, and this is why I've developed a lot of content all for free for you guys, is I want to make sure that we're valuable to you first and foremost, so we build trust before ever conducting any sort of business. And that's one of the things, is I want to always make sure that you're educated, that you could really own it, and you really understand. You could even teach people how to prepare for their own retirement. That's how thorough we want to be with you. We don't want you to just kind of say, oh, well, this is a specialist, and he gave me this recommendation, so I want to take it. We want you to really own it, to really understand everything, and we do not move forward with a recommendation until you do understand all the basics of this retirement aspect, and seeing exactly what is the best possible way to utilize American funds, and to utilize different things on how you could roll over a transfer into something that has more preservation, and so they'll give you that safe consistency with a lifetime income at a later date, if your goals pertain to that. So once again, give us a call at any time, and thank you very much for watching this video. I hope you found some value in this, and please subscribe to our YouTube channel so you get the most updated videos. Thanks, guys.